We're seeing global shipping stocks slide as around 45,000 dock workers along the East and Gulf coasts walk off the job. Our next guest says, and they say, who stand to benefit and what industries are most at risk during this strike. Here with more, we've got Bruce Chan, transportation and logistics analyst at Stifel. Bruce, let's start with your base case here. How long do you believe this strike will last?
Yes, good morning, Brad, and thank you for having me. So our base case here is 2 weeks, and there's no real hard science to that, but I think a lot is going to depend, obviously, on the political situation and the willingness of the Biden administration to intervene here. Yeah, our base case is about 2 weeks.
All right, so Bruce, let's talk to us a little bit more about the economic impact here, because I think a lot of investors are asking themselves ultimately what this could mean. Many of them trying to figure out whether or not it's going to have an economic ripple effect, what that means for their portfolio. What's your early read?
Right. So the first thing I think it's important to do is to contextualize the magnitude of what this disruption could look like. And this is not something that we think would approach anywhere close to the scale of the post-pandemic surge in 2021. You know, that was really a globally coordinated system-wide shortage of supply, coupled with the resurgence of demand, really across the world. But that doesn't mean that we, couldn't or wouldn't see significant impact from a stoppage here. And the real key now, I think, is how long ultimately is the strike going to last? If it's something that's 1 to 3 days, probably not as big of an issue. I think that's relatively digestible, especially given, what we see as pretty slack supply in the freight system right now. But the longer this goes, the more the impact scales, and really it starts to scale exponentially. Inflation for consumer goods, I think, is going to become an issue if we start to get into that 2 week time frame. We might start to see shortages of consumables. And then, where we probably be most worried is for, critical process inventories. Unavailability there could cause shuttering of production plants, potentially, furloughs and layoffs. Obviously, that's something that the administration wants to avoid.
So, Bruce, with that in mind, where do you believe the administration might need to make its voice known? Where do they need to, similarly as they've stepped in the past negotiations in the auto workers case, where might we see the Biden administration throw some weight around or try to show some solidarity here?
Yeah, so they're really having to thread the needle politically, because on the one hand, this is a pro-union, pro-labor administration. We're obviously in an election year. We're a little bit more than a month away from an election. You've got some of the longshore constituency in key swing states. So they've signaled that they would be supportive of an organic negotiating process. But once you get into that, again, 2 to 3 week time frame where you start to see broader economic implications, I think, is where you could see them start to invoke Taft-Hartley. And, that would really bring about an 80-day cooling off period. But I think, the key thing to think about there is that even during that period, you could see slowdowns in work. You could see, the ILA bring down shifts. So we still really wouldn't be at full capacity even in that situation.
So, Bruce, let's talk about a little bit more about the plays here that are at risk, or maybe you could position yourself to benefit from this. One of the plays that you say are actually could be beneficiaries of the strike, I believe, are FedEx and UPS. Why?
Yeah, so air cargo essentially is the only clear beneficiary we can see in this situation. It's essentially the only way to move products in country and bypass the ports. If you think about diversion to the West Coast ports, for example, the West Coast ports are operating with pretty good fluidity, but they're essentially at capacity. And the same is true in Canada. Halifax, the number 4 port in Canada, is pretty near capacity. Montreal is going through its own strike right now. That's the number 2 port in Canada and the number 1 on the East Coast. So there really are not a whole lot of options in terms of a plan B here, other than air cargo, which is significantly more expensive, probably only available to high value goods and again, some of those critical process goods. So that should be a real headwind for anybody that owns and operates aircraft capacity.
Is there a total economic cost that you're anticipating, even as you're kind of looking across the companies that will be most impacted, a total blow to the economy for the 2 weeks that you were talking about that this could potentially go on for?
Yeah, I mean, I've seen estimates out there in the trade press, citing a couple $2 billion or a few $1 billion per day. But again, I think this is something that starts to scale exponentially in terms of the overall impact to the U.S. economy. So, couple days of strike, probably a more minimal impact, but it starts to get much more significant, after that period.
Bruce, are many of these companies, many of the shippers, many of those at risk of being, I guess, challenged, at least in the short term? Do they pretty much have checks in place right now that they are better positioned than maybe they would have been 5-6 years ago before we saw more of these strikes begin to happen?
I would say technology and supply chain planning is probably a little bit better. So, one of the things that you saw some of the big box retailers do is to pre-position inventory. That happened earlier this year than it has in previous years. So, as far as consumers should be concerned about holiday peak goods, I don't think there's as much of a worry there. But it's those, consumables, especially the perishables, if you think, bananas, cherries, coffee, European beer and wine, those are things that can't be preloaded into inventory. Those are the things that I think we'll be a little bit more concerned about.
What in the negotiations would be perhaps the biggest delta between the cost structure that companies that go through and work through these ports would then have to consider post-negotiation that investors would also have to kind of price into their models as well? And is there any inkling that we could get to that point where some of these companies are going to have to come out and say, all right, we've got to revise what our cost of doing business through these ports looks like and how it's going to impact how investors have already modeled out for growth for these companies and the expense basis?
Yeah, thanks, Brad. Look, I think for the importers themselves, there is, an inflationary cost element here. Ultimately, that probably gets passed through to the consumer. So, ultimately, this will be inflationary for everybody. But if you think about the total logistics cost inputs for, most goods, they're on average in the low single-digit percentage. So, from this issue alone, we don't see a major impact to the end consumer. But for, the operators that are in the middle, there certainly is an inflationary impact to consider here.